Yeah, hello. So thanks for the introduction. I'm very happy to present here to this exciting audience this paper. The title of the paper is The Macroeconomic Portfolio Effect of Climate Policy. And the essence of the effect that I'm alluding to here has actually been described by Feldstein in his 1977 paper on land rent taxation, where he showed that land rent taxation is not, and in contrast to what Henry George earlier claimed, is not neutral. And this intuition can be transferred to the case of Pigouvian taxation and also more generally to taxation, rent taxation for distributionary purposes. And this will be the main content of this talk. So climate policy not only affects the flow of emissions, but it also affects the rents of underlying stocks, and most notably in the case of climate policy, of course, the rents from fossil resource stocks. It creates additional rents by introducing additional scarcities to the system, and also shifts rents, for example, from the resource owners to the government. Now, traditionally, the view on rents has been that rent taxation, being neutral, is a very convenient way of raising public funds. And then rent taxation was mainly seen as a distributional issue. So because it's easy to get the rents and take them away from somebody, you could then redistribute them and mainly cater to those needs. But as I said before, of course, collecting rents is not neutral, as Feldstein proved. And actually collecting rents and redistributing them both has efficiency impacts. And it can be shown that under certain circumstances, which I'm going to expand in this talk, it may actually improve efficiency. And this applies to the case of land, but here I'll take it to the context of carbon pricing. So to expand on this a little bit, here this graph is to show you that climate policy does entail significant shifts and increases in rents. So this is a graph from a study by my colleagues at the Potsdam Institute, and it shows the net present value connected to fossil resources over the century and how it is affected by different climate policies of different stringency. And there are two things to see in this graph. One is the total rents connected to fossil resources increase with the scarcity or with the stringency of climate policy. So in this case, the 450 ppm target values are higher. The rents are high in that case. And it also means that an increasing share of the rents is not attached to ownership of the resource, but to ownership of the permits. So if the public sector collects those rents, it can then still, and that's a traditional view, use them for a number of things to improve social welfare. I'm not going to talk about a double dividend here. Of course, that's one option. But now here, this is more the traditional perspective, the redistributional issue. Now, it has recently been back on the agenda with the book of Thomas Piketty, who showed that empirically there's a rising share of non-labor income, or that non-labor income becomes more important, and also that there's a rising inequality in wealth. And that, although he does not specifically focus on rent taxation, this certainly puts distribution back on the political agenda. What I'm going to address here a little bit is that addressing intergenerational inequality may also improve efficiency. An alternative use of the revenues from climate policy is to support resource efficiency improvements, since resources become more scarce under climate policy. That's also part of the model that I'm going to present. And of course, there are all other kinds of options to use the revenues from climate policy, but I'll just focus on the first two here. Just a second. So the previous slide was just concerned with the traditional view that rent collection is neutral, but collecting rents may itself introduce a beneficial distortion. And the mechanism behind this, distortion, which could be called a macroeconomic portfolio effect, as a preliminary title, works as follows. So if you have at least two revenue-generating assets as alternative investments for households, and you tax the returns from one asset, naturally investors will turn to the alternative asset. And this dynamic effect is unambiguously welfare enhancing under two conditions. First, the fact that you're taxing is in fixed supply. And second, the alternative asset that investment turns to is previously undersupplied. And this actually adds an efficiency argument for taxation, for rent taxation, in addition to distributional and Pigovian motives. And that's the main point of this talk. So the classical case is the case of land and capital as alternative assets, where Feldstein showed that land rent taxation is not neutral, and we showed in another paper last year that actually distributional issues are also of central concern here. And this talk now focuses on the case of alternative assets being resources, fossil resources, and capital. And the role of the land rent tax, of course, here is played by carbon pricing. So now for a bit of a formal model to just focus on the effect of rent collection. On the demand side, we employ a modified Blanchard-Yari continuous overlapping generations model. It's modified in the sense that individuals in our case can choose between two assets rather than just one. So there's capital, producible capital, and a fossil resource stock, denoted by S, which they can buy and sell on the stock market at a price P. And then there's the distinguishing but standard feature of this type of overlapping generations models, that agents have uncertain lifetimes, so they are born at a certain rate, phi denoted here, and also have a death rate or probability of death, phi, and then no bequests in this model. And this leads to the standard feature of the generation replacement effect, so continuously wealthy agents that possess capital and fossil resource stocks are replaced by fundless newborns. And this slows the growth of aggregate consumption and leads to capital underaccumulation. On the production side, we don't have two consumption goods, but just one, because, unlike the double dividend models. And we assume the production has constant returns to scale in capital, labor, and an improved resource. So in the production function, the E is the extracted amount of the resource, and A is the resource efficiency. Now, the government, in our case, does two things: a climate policy and support of resource efficiency improvements. For a climate policy, for illustrative purposes and to make the intuition as clear as possible, we just assume the simplest case that climate policy is implemented as an upstream emission trading scheme. So in this case, it's not a tax on consumption goods, but really a tax on resource extraction, or an instrument applying to resource extraction. And we assume that the emission permits have short permit lifetimes. So that means that the government has really close control over the extraction path, so that we can assume that the resource owners may extract an exogenously given fixed fraction of their stock. So there's a direct link between the ownership of stock, of fossil resource stocks, and extraction. And the extraction parameter here is just sigma. Okay, so there's no endogenous extraction, because we want to focus here really on the collection of rents rather than the effect of rent collection on the extraction path. And for the same reason, we do not analyze the optimal choice of the parameter sigma, or likewise the optimal choice of the carbon budget. That could be optimal, could be following a climate policy rationale or any other rationale. It's just not in our analysis. It's arbitrary in our model. But we focus on one crucial policy parameter, which is the auctioning rate of the permits, denoted here by T. Now for the public investment side, the public investment in R&D here takes the form of resource efficiency improvements. So the government, we assume that the government invests into resource efficiency improvement exactly to the point that the diminishing resource supply is offset. So the effective resource supply, A times E, is constant in our model. And that improves analytical tractability, of course. And I compared just two polar cases. One is that R&D is completely financed by auctioning revenues, by auctioning the short-term permits. And the other case, the reference case, so to say, is that R&D is just financed by lump sum taxation. So just briefly, that's the dynamical system. The first two equations for resource extraction and resource efficiency improvements are mainly driven by our assumptions that I just explained. The third equation is the standard capital dynamics. And then the fourth equation is a no arbitrage condition. It looks like the hoteling rule with just one modification. The second term reflects the fact that we can enforce any arbitrary extraction rate sigma on the economy. And you see that that element in the equation depends on the auctioning rate T. So there's a price effect. If we change the auctioning rate of the permits, we affect also the price of the fossil resource stocks. And the second important equation that I want to draw your attention to is the fifth equation here, the dynamics of the capital consumption, of the aggregate consumption, sorry. The first half is just the normal Keynes-Ramsey form, and then the last element reflects the mentioned generation replacement effect. So in the numerator, you see the missing wealth of the newborn generations. So a fraction phi of the population does not share capital or fossil resource wealth. And via the price of the fossil resource stock, this is also affected, of course. The size of that effect leading to underaccumulation is also affected by the permit auctioning rate. So another thing to note is that even if the price of the resource stock falls to zero, the generation replacement effect still remains non-zero because you can't compensate the newborns for not having capital. Okay? You can only neutralize their lack of fossil resources. The assumptions that I explained before lead to a constant effective resource supply and thus to a balanced path on which capital and consumption are constant and just depend on the auctioning rate T. Okay, and now I'll compare the two cases where R&D is funded by lump sum taxes or funded by auctioning permits. And the two crucial equations for that are the K and the C equation on this slide. And I'll just show you a graphical analysis of this. So here the parabola denotes the curve where capital growth is zero, and the hyperbola is the curve of zero consumption growth. And the intersection of the two curves, of course, is the steady state level or the balanced path level of consumption and capital. And the dashed line denotes the Keynes-Ramsey level of capital. And in this case of an OLG, the Keynes-Ramsey level of capital can be considered the social optimum. And you see here that there's underaccumulation. So capital levels and consumption levels are lower than in the Keynes-Ramsey case. Okay, and this is of course due to the generation replacement effect. Now if I auction some of the permits and I reduce the generation replacement effect, the hyperbola shifts downwards, but the intersection of the two curves shifts upwards. So I have higher capital levels and higher consumption levels. And this shows that auctioning short-term emission permits actually leads to higher aggregate consumption and is preferable even to lump sum taxation. Okay, one more thing that I need to point out here is, as you saw in the equations, you can never get to the social optimum by the price effect alone. As I said, the generation replacement effect never disappears. But so far, I've also assumed that the permit auctioning rate is chosen exactly so that revenues from permit auctioning finances R&D. But it needs not be one. So there might still be scope to collect more of the rents and then use them for additional measures. And one thing that you can use them for is redistribution. And in that case, you can even attain the social optimum. So assume that there are enough resource rents first to fully finance an offsetting amount of resource efficiency improvements, and second, also to compensate the newborns for not having capital. And in that case, it is possible to achieve the social optimum, okay, because you can fully offset the generation replacement effect if you transfer all these additional funds to newborns only, in our case. So that's the intergenerational redistribution effect here. So there are a number of variations of this model. Maybe due to time constraints, I'll just point out the first two. The first is I said that I choose a fixed extraction rate sigma here in my model. Actually, the model accommodates any kind of extraction path as long as it's matched with an exact same or mirrored resource efficiency path. The main thing here for the analytical tractability is that the effective resource supply stays constant. The second thing was that I exogenously fixed the extraction dynamics, directly controlled them. And of course, the question is what happens if you have an endogenous extraction path. For example, under long-term permit schemes, which are more usual in reality, or under a carbon tax. And the main thing here is the intuition stays the same, of course. If you tax the rents from fossil resources, they are less attractive as an investment, and people will turn towards alternative assets, producible capital in our case. And if that is undersupplied, you will have a welfare improvement. So that's the basic mechanism here. So let me summarize. I pointed out that climate policy may provide a non-environmental benefit if it introduces a portfolio effect and if capital is underaccumulated. I showed this here for an emission trading scheme. And overall, this implies an efficiency reason for resource rent taxation, additionally to distributional arguments and also additional to environmental motives. And then finally, I pointed out that social optimality actually requires, at least in this setup, requires intergenerational redistribution towards the young. Thank you.